Welcome to the Explainer. We're looking at the week of February 10th, and let me tell you, this one could define the entire first quarter for the financial markets. We're calling it the decisive week, and in the next few minutes, we're going to break down exactly why.
Okay, let's dive right in. The market is at a huge fork in the road. Seriously, we could see a massive breakout or a pretty sharp downturn. And the data coming out this week, that's going to be the catalyst that decides which path we take for the rest of the quarter.
So here's the billion-dollar question on every single investor's mind. Are these high interest rates going to stick around? For months, the market's been in this holding pattern, just waiting for a clear signal. Well, this week's data might finally give us the answer.
So let's set the stage. First, let's unpack the tension that's really gripping the market and talk about the most likely scenario, what analysts are calling the base case. You see that number? 55%. Right now, that's the probability the market is pricing in for a significant rally in the US dollar. The base case, the most likely outcome, is that the US economy will hang in there, proving it's resilient, which basically forces the Fed to keep interest rates high. This slide right here just perfectly captures the tug-of-war happening in the market. On one side, you've got growth that's clearly slowing down. Job creation has been weak and shoppers are starting to hold back. But on the other side, inflation is just refusing to quit, forcing the Fed to stay hawkish, which is just their way of saying they have to keep interest rates high to fight it. Now, let's get to the countdown. Think of this week as a series of 3 critical tests for the US dollar. Each one of these data releases has the power to completely rewrite the market story.
First up, on Tuesday, we get a health check on the American consumer with the retail sales report. This is going to be our first major test of the week. So the market is looking for a 0.4% increase, but the real story is in the thresholds you see here. If we get a number above 0.6%, that screams strong consumer, which is super bullish for the dollar. But if the number comes in weak, below 0.3%, well, that's when you'll hear the recession alarm bells start to ring, and that would likely send the dollar and bond yields down.
Next up, on Wednesday, every single eye in the market turns to the labor report, the non-farm payrolls, or NFP. And you know what? The forecast for this one is historically low. Yeah, the forecast is for just 70,000 new jobs, which sets up 2 totally different paths. A strong number, say over 90,000, gives the Fed every reason to stay hawkish and keep rates high. The dollar would absolutely soar. But a weak number, anything below 40,000, could trigger the dovish case, signaling real economic trouble that might just force the Fed to cut rates. And that could cause the dollar to crash.
And finally, the week builds to this, the ultimate verdict. The core CPI inflation data drops on Friday. This is the report that could seal the deal for the entire quarter.
This inflation thermometer really tells the story. The market expects a 0.3% rise. If that's what we get, or even higher, it completely validates that higher for longer interest rate story. The dollar gets stronger. But if that reading comes in cool, say below 0.2%, it signals inflation is finally breaking. That would speed up calls for rate cuts and, you guessed it, weaken the dollar. So, with these 3 major tests laid out, the real question becomes, how do we navigate all of this? Let's get into the playbook. This flowchart brings it all together beautifully. You've basically got 3 key scenarios. The most likely, with a 55% probability, is the base case. Strong data leads to a bullish dollar. Then you have a 30% chance of a bear case, where weak data causes a total reversal. And finally, there's a 15% chance of just chaos, where we get mixed signals and the market is volatile and goes nowhere. So that brings us to the actual strategy. Let's really focus on the most probable scenario here, that 55% base case, and see what the playbook suggests. Okay, in a strong dollar world, this FX matrix clearly lays out the potential winners and losers. You'd want to look at buying the US dollar against currencies like the Japanese yen and the Canadian dollar. On the flip side, you'd be looking to sell currencies like the British pound and the euro against the dollar. And notice, GBP/USD is flagged as the weakest of the bunch. And that's mostly because the UK economy is really pointing towards stagnation. It's also absolutely critical to watch how other assets are connected. As this diagram shows, a stronger dollar usually puts a lot of pressure on gold and US stocks. For the stock market, it's that classic good news is bad news situation, where a strong economy means interest rates stay high for longer. Meanwhile, you'd expect to see Treasury yields rise right along with the dollar. And this brings us to how you actually trade this. Here are 4 essential rules for managing your risk this week.
1. Reduce your position size. Protect your capital before the numbers hit. 2. Don't try to predict, react. Trade the momentum after the news is out. 3. Use wide stops. Volatility could be insane, so tight stops are just dangerous. And 4. Focus on that primetime trading window right after the data is released.
Finally, let's not forget the other risks out there. The US dollar index itself is sitting at a huge technical level, and if the market is thin, any moves could get really exaggerated. Plus, there's always the chance of a headline shock from a major event in China or somewhere else in the world. So let's boil all of this down to the final takeaway, shall we? It really all comes down to the simple equation you see right here. Strong data means the Fed can afford to be patient, and that means a strong dollar. Weak data forces the Fed's hand towards cutting rates, and that means a weak dollar. The market is leaning one way, but this week the data has to prove it. So, your playbook is set, the key levels are defined, and the scenarios are all mapped out. The data is coming, and it will absolutely define the trend for the next several weeks, if not the whole quarter. The crucial point now is to stay nimble, protect your capital, and just wait for the market to show its cards.
And just a quick reminder for everyone, this analysis is for informational purposes only. It is not financial advice. Trading involves a high level of risk, so please be careful out there.